So let me. Hi. Hi. You can hear me? You guys can start. All set to go?
We're ready. Okay. All right, good afternoon. Good afternoon. Hello. We're going to try to nourish both your mind and your body over this lunch. So we are going to have a panel during lunch. Please feel free to continue to eat. I just asked you to save some dessert for the rest of us here on the dais, if you don't mind. So my name is Chris Calabia, and I'm from the Bill and Melinda Gates Foundation. And so pleased to welcome you to this luncheon to talk about central banks and innovation. And I'm very happy that we have two experts on this subject here to join me today for this discussion on the dais. Allow me to introduce first Deputy Governor Aisha Ahmad, the Financial Stability Section at the Central Bank of Nigeria, sitting to my immediate left. The Deputy Governor is a member of the Monetary Policy Committee, as well as the Committee of Governors at the Central Bank there. And her primary responsibility is for financial policy, as well as the regulation of the banking and the payment systems. She chairs the National Payment Switch, as well as the Financial Inclusion Technical Committee. And if you were here yesterday for Mary Ellen Iskandarian's keynote speech, you saw the Deputy Governor in a video in her prior life in the private sector when she was an executive director at Diamond Bank, one of Nigeria's largest banks, and one of the banks that worked with Women's World Banking on the Beta savings product. And the Deputy Governor has over 20 years of private sector experience in financial services. So welcome, Deputy Governor, to Ann Arbor. Sitting to my left, your right, is Leonardo Gambacorta, who is the head of innovation and the digital economy unit at the Bank for International Settlements in Basel, Switzerland. If you're not familiar with the BIS is a bit like a central bank for central banks, in a way. He is an economist by training, and Leonardo served as head of monetary policy at the BIS, as well as the head of money and credit unit, and the head of the banking sector unit in the research section at the Bank of Italy in Rome. And his primary research interests include monetary transmission mechanisms, effectiveness of macroprudential policies on systemic risks, and the effects of technological innovation on financial intermediation, which is his main area of focus currently in his new role at the BIS. And I'm Chris Calabia from the Bill and Melinda Gates Foundation, as I mentioned. And at the Gates Foundation, we believe that every person deserves the chance to lead a healthy and productive life. And so you're probably very familiar with the Gates Foundation's work in health, medicines, vaccinations, and education, and so on. But we also have a focus on financial inclusion, because a good body of research suggests that when people who are unbanked or poor and marginalized groups and women, when they have access to accounts, and especially digital financial services accounts, they are better able to lift themselves out of poverty by improving their ability to save, to borrow, and to make payments, and to invest in their futures. And so that's why we care about financial inclusion, and I'm very happy to partner with the University of Michigan on this important project. I'm also a recovering regulator and central banker myself, I have to say. I worked for 25 years for the Federal Reserve Bank of New York in the supervision section there, and also spent 2 years at the BIS as well, working for the standard-setting body for bank supervisors called the Basel Committee on Banking Supervision. And so I should stress that any comments or opinions that I may share today are my own, and do not necessarily reflect those of the Gates Foundation or, frankly, anyone else who matters. So I'd really like to thank Michael Barr, Adrian Harris, Chrissy Baer, Kelly Brown, Tracy Van Duzen, Ashton Smith, as well as the large number of RAs and staff here at the university, Sam, Jesse, Sean, Jay, Jennifer, Lucas, Cole, and Nick for putting on such a wonderful conference. I hope you might join me in a round of applause for them to thank them for all their hard work to make this come together. So we're going to talk today about innovation, and in particular the role that central banks have in responding to that innovation in the marketplace. And Leonardo, at the BIS, you and your colleagues have been monitoring and reporting on the emergence of some disruptive technologies in the marketplace and some new service providers in the financial services spaces. I was wondering if you could tell us a little bit about how these new players have expanded into the provision of financial services. And I know that you have some slides you'd like to share with us on this question.
Yes, I have. First of all, thank you, Chris. Thanks to all the organizers for inviting me to this panel. It's a great pleasure and honor. I have prepared some slides to introduce the topic of big tech in finance. And these slides are based on some research that we have conducted at the BIS, and they are summarized in a chapter of our annual economic report. Obviously, the usual disclaimer applies. So, we know that technology firms, we have in mind Alibaba, Amazon, Google, Facebook, Tencent, the ones that are on the left side of this slide, so-called big techs, have grown rapidly in the last decade, and they have started to do some inroads into finance. So. These firms are very big. This is the name big tech. And indeed, they have a level of market capitalization that is higher than those of the GSIBs, the one that are the biggest financial institution in the world. So why technology firms venture into finance? They have the so-called DNA. So it's a data, network externalities, and activities that is a sort of a feedback loop that allow them to have a lot of synergies. You can think about a payment firm having a lot of data, creating network externalities, developing in the platform new activities, and these activities will bring new data. So it's sort of a reinforcing loop. Indeed, the first fact that I want to mention to you is that big tech have a portion of their revenues that derive from financial services. But at the moment, this part that you can see on the left side of this slide is still relatively small. It is something like 11% of the total revenues, while their core business is still in information technology and consulting, so cloud computing, data analytics, that represent around 46% of total revenues. We know that big techs, they serve globally, but when we look at the the big tech subsidiaries that is on the right-hand side of this slide, we can see that their operations are mainly located in North America and in Asia Pacific, but they have moved quite extensively in China, as we know, with Tencent and Ant Financial. But still, they are developing, also expanding rapidly in emerging market economies, in areas that are Southeast Asia, East Africa, and Latin America. So the second fact is that the development of big tech financial services follows a very precise pattern. So, for example, payment services were the first financial services that big tech offered. And the example we have in mind are typically Alipay of the group Alibaba and PayPal for eBay. And these are financial services that are fully integrated into the e-commerce platform. The development of big tech payment service is higher in those countries that had less financial developed credit card payment. And indeed, they benefit from the fact that in a lot of countries, there is a high fraction of the population that use mobile phone. So this could explain, for example, why China has an outstanding level of big tech payment over GDP. It's 16%, with respect to very low level in the United States, India, Brazil, Indonesia, and United Kingdom, for the combination of these two factors. So as a sort of a prolongation of the story, so after payment service, big tech started to offer via their application also other products, and these are typically wealth management products and such as money market funds. So in these slides, I just represent the composition of one very important money market fund, because it's the biggest in the world. It's the Yubao that is offered by the Alipay group. And I want to show some interesting facts. On the left-hand side, you can see that the composition of the asset of Yubao are mainly in bank deposits. So 60% of the asset of Yubao are in bank deposit. And in terms of the maturity of Yubao asset, on the right-hand side, you can see that around half of the asset have a maturity of less than 30 days. So what does it mean? This is, first of all, is that there is a relationship between a big tech and banks that is quite complex. And then this also reflects also potential financial stability concern, because imagine a run on the money market fund that is composed of bank deposit short term. This obviously will create some difficulties also for bank funding. So the last fact I want to show you is that big tech credit is also offered by these large technology firms, but it is still small with respect to other forms of financing. If you think about the new fintech credit in 2017, this represented 0.5% of total outstanding credit in the world. And even in China, China is at the vanguard for the offering of this product, is only 3%. Some studies conducted at the BIS show that there is a negative correlation between the level of financial development of a country and the level of big tech credit. You can see this from the left-hand side part of this graph, where you have on the horizontal line the fraction of the number of branches per adult population, and on the vertical axis you have the logarithm of the ratio between big tech credit and total credit. But also there is one final consideration I want to do, is that yes, big tech credit is small, but it's very different. It's very different from bank loans. And you can see this from this right-hand side, where with some colleagues in China, Yiping Wang and Anqiu, using unfinancial data, we have tried to understand the correlation of credit with respect to asset price. And we have seen that while traditional bank loans are correlated with asset price, and this is at the basis of, in the model, what we have in the financial accelerator mechanism, big tech credit is not correlated. It's more correlated with the business cycle. So this changed completely the monetary transmission mechanism and the way central banks should factor in the development of big tech credit. In this final slide, I just report some additional studies that have been conducted at BIS if you want to develop further some of these points.
So Leonardo, that's a fascinating overview, and I commend the paper to the audience's reading later. It's a great paper looking at big tech and these very large firms getting into financial services. Can you tell us a little bit about maybe some of the benefits that they might bring, as well as some of the drawbacks? You mentioned the monetary policy challenge as being maybe one of the drawbacks, but are there additional things that we should think about as regulators and supervisors?
So it's a very interesting question that I will try to develop, just making one example that is the one for the market for credit. So first of all, the benefit and the cost of big tech in finance derive from the DNA. So this data network activity feedback loop creates a lot of potential and benefit in terms of financial inclusion, but also a lot of risk. So let me start with the potential, in having as an example the credit market. So in terms of provision of credit, there are benefits coming from the screening activity and the enlargement of the provision of credit to the financially excluded. So there is already literature showing that the use of machine learning and big data for credit scoring allows to the big tech to serve credit to a lot of segments of the population that are financially excluded. And this is clear with the experience of and econometric analysis that we have conducted for China and Argentina with the Mercado Libre. Other potential benefits are derived from the fact that there is no need for collateral. So what we say is that, in a way, data substitutes collateral. And this is also producing a positive effect in terms of financial inclusion. But as I mentioned, there are also some potential costs that derive from the data, from the use of the data. And these are basically two. First is potential effects derived from market power. And the second one is about the misuse of data. So market power, it is clear. So big tech, they can become a dominant player, and basically they can consolidate their position by raising barriers to entry, or they can simply exclude other firms from the provision of their services in their platform. They can just simply offer their own products. And the misuse of data, there are also some studies that show that it could be that as big tech are very smart in price discrimination and in rent extraction, this could be not beneficial for consumer. And there is a debate in terms of how to reallocate this consumer surplus. And also potential negative effect could be derived from the fact that if the algorithm that they use are particularly smart and in detecting the risk, some part of the population that are risky, that they should be, for example, insured, they could be excluded. Or also some form of discrimination in terms of minority. Think about, I don't know, there is a paper that showed that black and Hispanic in the US could have less potential benefit than the other categories. So at the end, in terms of public policy, I think that big technology firms bring a lot of potential benefit, but these have to be evaluated in terms of also the cost. So at the end, it's a public choice.
Yes.
And it's a choice of societies. Societies could have different preferences, also depending on their different level of financial development.
Yes, well, having read your paper and heard your remarks today, it feels to me like this is maybe just the beginning of the chapter of big techs and finance, that, as you said, their credit extensions are rather low. But that said, Facebook has 2.7 billion customers. Gmail has 1.5 billion users. I mean, these are larger than most countries. And so they have a tremendous base to expand to if they choose to do that. And so we'll need to think carefully about those subjects. So thank you very much for that overview, Leonardo. Deputy Governor Ahmad, could you share some of the perspectives, perhaps, as a central banker and supervisor, working in a dynamic and vibrant market like Nigeria, which has a very young population, growing quickly? You know, what types of products and services and providers are you seeing that are disruptive, and how do you think about those as a central banker and supervisor?
Okay, thank you. Can you all hear me? Okay, so I think we're seeing disruption across the value chain of financial services in Nigeria. I know that when people talk about tech, data, innovation, digital innovation, people tend to look at that as disrupting what the traditional banks are doing. But interestingly, Nigeria, and I'll use Nigeria a lot because that's the jurisdiction that I come from, we find that we see this happening even within traditional banking services, where banks are deploying AI-based solutions for convenience of customers. They're using it for their credit scoring. They're using chatbots increasingly. It's sort of in terms of driving product development, product design within the banking sector. And then some of these technologies as well, the fintechs are partnering with the banks and are providing these as value-added services for the banking system. Because I think it's really important to situate that there as well, to say that this disruption is not just expanding the number of players, it's also changing what we see within the banking sector. We think that as regulators, we're always looking at how we can bring the cost of financial services down to reduce the cost. And we see technology, innovation, new channels of delivery, reducing cash and the cost of cash as a huge opportunity that we can leverage. Having said that, we're seeing disruption in savings, for example, new savings apps that is helping to bring beyond typical savings, government savings. People that want to invest in government treasuries can now do it via their mobile phone. In the past, this used to be reserved for the high net worth individuals that have access to large private banks. We're seeing happily disruption in the micro-lending area, where you have some companies providing micro-loans to often people that ordinarily would not qualify for a loan within a sort of typical bank. But I think one of the biggest disruptions we've seen is in the payment system itself, enabling merchants to collect, payment for goods and services. You talked about Nigeria, about 200 million people, youth, so 60% of that is people under the age of 35. A lot of creativity in there, a lot of, the informal side is pretty big, but it's also increasingly bringing up these new entrepreneurs that are leapfrogging your typical open a store. It's like I have an idea, I go onto Instagram, I sell, I collect, somebody needs to give me a solution for that. And Instagram is across borders, it's Nigeria, it's Kenya, it's Egypt, it's the UK. I have to deliver, I have to collect payment. You come to talk about the arrangements around regional payments and international payments. So we see fintechs entering the merchant acquiring space a lot. We see them providing solutions that I've spoken to. And of course, the opportunities. So in terms of how we see it as regulators, I've said one part of it, we like it because if it brings down the cost of providing services, all well and good. The data helps us to make better decisions, even for the banks. And when we talked about financial health today, and if you want central banks to measure, we're going to need that data. Of course, the opportunities where financial inclusion sort of concerned, the results speak for themselves. Today, Nigeria, 63% is our financial inclusion number, and a lot of that has happened in the last 7 years. We've seen astronomical increases in instant payments, POS use, reduction in check use, e-transactions, digital government digitizing their collections, and we've seen all of that. So those are the good benefits. And of course, it's also a huge opportunity for a regulator to expand their sort of coverage in terms of the types of organizations you supervise. Sometimes we also talk about that as a problem, but it's actually an opportunity to be able to see more come out of the shadow banking space where you had no visibility to see these new companies emerge. The risks, apart from the cyber risks that I think is par for course when it comes to technology, so let's pack that. For a regulator, you're thinking about the fragmentation of the number of organizations. Some of them are banks, some of them are not banks, some of them are tech companies. There was an earlier conversation about what regulators should be doing to collaborate. Should the telco regulator be collaborating, for instance, with the banking regulator? So there's that fragmentation. You have to consider borders. If you're serving Nigerian customers, but you're not registered in Nigeria, how do I sort of ensure that consumers are protected, their data is protected? So new questions about cross-border collaboration, sort of in that respect. Proportionality, over-regulation, under-regulation. If you talk to a typical bank, they'll tell you that the fintechs are not regulated properly. They feel over-regulated, and they think you're giving these guys a free pass. Should you use the same risk-based regulatory supervisory framework for these companies, or should you come up with something different? So for us, these are questions that we need to answer as the market evolves. I love the earlier conversation about control versus innovation and those trade-offs. And I think there's no simple answer. We'll keep having to make those trade-offs as it works for the jurisdiction. What I would favor is a nuanced approach, an inclusive approach. And I think that the fact that many central banks in emerging markets are doing sandboxes should give us comfort that they're willing to give these companies sort of a playing ground where we can just observe in an environment of trust, because they also have to believe that if they come out, so to speak, you won't be using the knowledge you have of the operations to, should I say, make it difficult for them to innovate. I think one other thing I didn't mention is that usually when it comes to innovation, the companies are young, they're creative, and operational risk is not exactly what's on their mind when they start.
Or anti-money laundering, or that.
Yes, or AML, CFT. That is what you'd expect of banks, and banks have frankly come a long way. They probably didn't start this way. They've had years and years sort of that. So from a regulator's perspective, we welcome this for all of the good things it can do for us on financial inclusion, reducing the cost, improving access, all the problems around ID, and all those barriers, address verification. If technology can do this for us, yes, but then we need to then balance with all of these other considerations.
Yes, well, thank you for that wonderful overview of the various trends taking place in Nigeria, but you're also reflecting on some trends that, although you mentioned these are largely your experience, there are experiences in other countries as well. And in particular, I wanted to call out one point that you mentioned, and that is the cost savings that technology is driving.
Yes.
Saving money on these transactions is not just an efficiency thing. It actually is a powerful driver for inclusion. Because if you look at the legacy banking model, bricks and mortar branches and agencies and so on, it's very expensive to build a brick and mortar banking network.
Yes.
But we've found, and some of the research we've sponsored has found, that when you move to digital financial services, you can cut costs by 90%. And that means suddenly you can serve a much larger population than you could serve before. It's much more profitable to serve people who live in rural areas and remote areas where you would never go and provide a branch. But I wanted to pick up on your point about innovation and the new kinds of companies coming into the space, and also the impact that they're having on the legacy companies. So Nigeria has a very interesting new banking license that's been introduced. And I was wondering if you could tell us a little bit about this payment service bank and what drove that decision.
Yes. Well, it's not new, I have to say, because there's a lot of excitement, because I think we've been waiting for Nigeria to decide how it's going to go, where sort of this big idea about bringing in new players, and what it does for expanding inclusion. So the Payment Service Bank is our way of bringing in more participants. Everybody focuses on the telcos because it allows the telcos in, but it's actually beyond the telcos. It's looking at anyone that has a channel that can be leveraged to create more access. So it's the supermarkets, it's the retailer, the big retailers, it's the mobile money companies, which in Nigeria usually have spent the last, since we licensed them about 10 years ago, building these agent networks. So it's anyone that has a network that can be leveraged to get more people access. When we're talking about costs, one thing I forgot to mention was that increasingly we see banks, instead of expanding their ATM sort of structure, what they're doing is expanding POS using agents because it's cheaper and the technology is nimble. It's easier to sort of maneuver and deliver the service. So the thinking behind the PSB, even though you have about 63% inclusion, our target is 80% by next year. You still have because of the huge population, you still have huge opportunities in the excluded. And what we're trying to do is to get more people access. Now, we've been licensing all sorts of institutions. We have microfinance banks, for instance, as well. We have switching companies. We have payment terminal solution providers. We have all of these sort of regulations that have enabled new players come in. But one thing we have found is that the pattern of provision still usually revolves around the urban areas. It's usually concentrated in certain areas. So one of the problems we're trying to solve with the PSB license, because if you look at the way the guidelines have been put, it's supposed to be technology driven, it's supposed to bring in more participants, it's supposed to be focused on 50% of, so if they're going to build any physical structures, we want that 50% of that should be in rural areas, underbanked areas, underserved areas. So it's specifically focusing on this exclusion problem in terms of access. And to track and to monitor how well we're doing, we're just completing our financial access maps. That it's going to be an interactive map that will show, broadly speaking, what the opportunities are in terms of financial access, where we have our banks, where we have ATMs, where we have agents, where we have PSBs, where we have, and another thing about the PSBs that I think is critical for us to know is that the telcos come with this established agent network that they've been using to deploy value-added services. Now, these are potential points we can use to expand our ID system, for instance. When we have the ID system, we came up with bank verification number a few years ago. We have 40 million Nigerians on that, and we're looking to expand that across the population. Now, imagine if you had 200,000, 300,000 more points where people can go and sort of register and all that. It totally opens up the opportunities for those that are excluded. We looked at the India model, payment bank model. One of the things we liked about that was the fact that the payment banks in India are focused only on deposit mobilization, at least for now. I think they have a 25% sort of focus on the rural areas. We have a 50%. Some of the additional things we put in, apart from increasing the sort of minimums we want in terms of rural areas, is that we thought it was also important what you were talking about, Leonardo, about market power and the fact that if you have, if a payment service bank has a parent that controls some services across the chain, you want to ensure that it is providing the same level of service across the entire participants in the market. The last thing you want is for some participants to get sort of better pricing or better service, and so and the guidelines sort of try to sort of address
create a level
all of
field.
that. It's still early days. We've just given approvals in principle, but we're very excited about the potential, given what we already know about the channels, that these organizations bring and the variety that these organizations bring.
Yes, well, thank you for the very detailed view into Nigeria and what's going on there.
Yeah.
Leonardo, perhaps you could help us look at the global perspective and think a little bit about some of the public policy challenges that we're facing now as regulators, and how is the BIS thinking about some of these issues at a global level?
Well, we consider them. We consider financial innovation at the center of our medium-term strategy. So indeed, there is the BIS 2025 innovation strategy that really reflects so a commitment of the BIS to embrace continuous innovation to prepare the BIS itself for the change of tomorrow. So we are doing this in two fronts. One is to be innovative in what we provide for the central bank community, and an example is as to support central banks that are doing very good things, as in the case of the Central Bank of Nigeria. The other is to innovate ourselves in terms of how we operate as an institution. So we see these as internally as a big change. Indeed, the one element of our strategy is the creation of the BIS Innovation Hub. And this will have three main goals. The first one is to identify and develop critical trends in financial technology that are of relevance of central banks. The second goal is to develop public goods in the technology space that are geared towards the improving of the financial system and globally to produce efficiency, and then to serve as a focal point for a network of central bank experts on innovation. So as we know, the IT revolution knows no border. Yes. It will be located in different parts of the globe. It will be in multiple locations in Hong Kong, Singapore, and Basel, Zurich. Yes. Another initiative is to foster policy-oriented research that could try to answer some of these relevant policy questions. And indeed, the creation of the unit I'm leading, the Innovation and Digital Economy Unit, respond to this need. And we have a number of projects that are currently in development in areas such as, one is big tech in finance and the impact in terms of competition. The second one is tokenization of assets, central bank digital currency, global stable coin, how this will impact in the future of the monetary system. Third area is more in general how financial innovation could impact on the macroeconomy and the conduct of monetary policy. And the last one is a point that it was also mentioned this morning many times into the panel, is the role of RegTech, SupTech, and GovTech. And in particular, one example is how to study the firms that take part to a sandbox if they this impact in their ex post performance. These are just, in a nutshell, a few elements of our strategy for the medium term to analyze how financial innovation and technology could impact on the work of central banks.
So that's really exciting and fascinating to see that the BIS, which I think traditionally is viewed as a very conservative organization, is actually pushing forward with ideas about innovation and trying to rethink things. And when I've heard Governor Mr. Carstens, the general manager of the BIS, talk about these things in the past, he emphasized two things. He mentioned the soft public goods, which the BIS has long done in terms of standard setting and so on. But he also talked about hard public goods. And do you have an idea what he means by that? Is he talking about actually software and that sort of thing?
No, the hard infrastructure are actually those examples that Aisha was mentioning. So we need to not to forget the fact that central banks create trust in the payment system, and a solid public infrastructure is very important. This morning there was also discussion in the panel about the experience of India with the digital ID and the payment infrastructure they have created. So in a way, the goal of central banks is to reinforce these aspects in order to create a very solid environment for the financial system in the future.
Yes, thank you. So Deputy Governor Ahmad, I was wondering if you could respond to that. Do central banks have a role to play in promoting innovation themselves?
The short answer is yes. The long answer is, where does it stop? Where does it start? Where does it stop, you know? So the legal framework needs to be in there. the regulation and the policy, they should do that. They should provide some of the utilities. Well, that's my view. I know there's sort of two camps in that respect, because we heard this morning about what are some of the potential pitfalls if they provide utilities and sort of the power to sort of take them away. We should be at the forefront of innovation because of all the reasons that we've mentioned and all the benefits. We've talked about the fact that inclusion is quasi into the mandate. So if it's going to help you achieve the mandate, and even if it wasn't inside the mandate, the truth is that it does help you foster the financial and the monetary and the price stability that you need. So we definitely, as regulators, need to be sort of very interested at that. The jury's out as to at what point we allow the market to self-regulate. I don't know if that time would ever come where the market can sort of by itself just go and, do this. Luckily, we're having this conversation. And when I meet other central bankers, I'm happy to know that we're not the only ones grappling with what these choices sort of should mean. A lot of the emerging market economies have leapfrogged some of the developed ones in terms of embracing technology because of the real issues that needed to be resolved. And I think these economies will be the test case for how well this sort of is going to work. Thus far, it's worked well for us to provide the infrastructure, for instance, set up a central switch, set up a central depository, make it fit for purpose for everyone to sort of plug in, There could be conversations about a single source of failure, right? So when that comes up, you come up with other solutions. I heard from one of the colleagues yesterday about what DLT can do to resolve, distributed ledger technology can do to resolve this single point of failure sort of issue. So as we sort of walk down this road, I think that we as regulators will always keep our eye on the pitfalls and the risks and find ways to combat them. If you look at the Nigeria experience, all of the regulations that we've come up with is what has enabled these companies to thrive. Let's not forget, without the licensing, without the rules, without the guidelines, they wouldn't be even there for us to see today. So you can't take the central banks out of the conversation about innovation.
Yes.
I think what needs to happen now is that at what point do we get to where we say, okay, it's time to hand over to this market.
What a wonderful way to sum up our conversation, both in this session as well as for most of the conference. I think we have time perhaps for one question. Is it one question? A very short question? Yes. So if you raise your hand, you must promise you can ask this question in one sentence, no run-on sentences. Yes, please.
Changes from where they started with bank deposits and now it looks like half of it is repos. What does this mean for monetary policy transmission? Especially since you mentioned that the shadow banking world is actually coming into light, but that slide shows something different.
Well, the monetary transmission mechanism will be definitely affected by this change. In the last slide, I don't know if you refer to the last slide or the slide on the money market funds, but in both cases there is an effect on the monetary transmission mechanism because in one case, the case of the correlation with respect to the asset price, we have in mind in the traditional macroeconomic model the financial accelerator. So this means that when, for example, there is a monetary tightening, there is an effect on house price that will amplify the transmission. In case of big tech credit, these effects are not in place simply because they don't rely on collateral. So this means that the credit will be more correlated with the normal traditional business cycle. So this could be an implication for the transmission mechanism. And a second aspect is related to the slide on the money market fund. there we can see that there is a complex relationship that has to be fully understood, because there is a sort of connection between the big tech and the bank in terms of their asset and liabilities. So this basically has to be analyzed deeply, also in relation with the different institutional characteristics. For example, the People's Bank of China was aware of this effect on the float that was in a way factored in by the creation of 100% reserve that now big tech companies have to deposit with the central bank. So this is just an example to show you that central banks are aware, are studying a little bit the evolution of the effect of technology. The response is not naive, has to be really well crafted, and it really depends on institutional characteristics.
So let me again encourage you to read Leonardo's paper on this subject of the big tech in finance. So with that, let me just sum this up very quickly by saying that today at the session we've learned that, and we know that innovation can help us to serve the poor and a broader section of the population better. Innovation can change the players in the marketplace, including the legacy players, and central bankers can drive some of that innovation. And here we have two excellent examples of central bankers who are driving innovation both at the global level and at the national level. So please join me in thanking both Leonardo and Deputy Governor Ahmad for joining us.
Thank you also, Chris, for putting this together and coming up with questions and things. So from here, everyone, we're going to go back to the auditorium, Global Forum Hall, where you started the day.
It was a great pleasure.
And we'll transition to our